little time kind of talking about like where we are and how we got here. I always like to start out because you all gave me the opportunity to do this last year. And so I'm basically taking my takeaway from last year, which I said that we'd have strong growth in late 2021, early 2022. Missing workers are still a challenge, and that the interest rates are going to be raised. And I got to do some formatting. The Fed will take action on inflation, but will be higher than recent history. All of those are like qualitatively true, but I think we definitely understated last year how rough this year would be in terms of persistence of inflation, and really how I think the Fed has really acted relatively aggressively, and yet inflation is still a very persistent problem right now. And so we just want to be thinking about, how sure we could be about what's going to happen next year. So I asked my students, and I've seen a few of them here, but general questions about the economy. And there's really two things that seem to be on people's minds right now. There's the inflation questions. What's the cause of inflation? Like, why is it so high right now? And what's being done to bring it down? And then there's the recession questions. Are we in a recession right now? How will we know? Why does everyone think one's coming? And how can we prepare for it? So let's just kind of like take a look at these. And like everything, my students know that I'm kind of obsessed with this whole Taylor Swift situation that's going on right now, and the fiasco for her tickets. And I think that really can help us understand inflation, what's going on. So what happened, if you missed it, they launched the ticket sales launched for her Taylor Swift's 2023 domestic tour, and immediately tickets were basically all sold out. Now, if you go on StubHub, if you go on the market for tickets now, you can buy them in next summer for Soldier Field for about $540 is the cheapest seat anywhere. If you want to be down on the floor, you're looking at $1,500 to $2,000. So why are prices being driven up so high? Well, to me, to an economist, it all comes down to supply and demand. So the supply of Taylor Swift tickets is limited, even though she's doing 50 shows and it's like 2 million tickets, it still far underestimates what the demand should be. So we have a limited supply, and we have high excessive demand leading to high prices. Initially a shortage, people couldn't get what they want, but as the market responds and tickets are available on resale sites at a market price, that price is quite inflated. Well, I think that's largely what's going on in our economy as well. When you have demand that's high and demand is pushed up, we've had high demand since coming out of COVID, and we've had a restricted supply, you're going to get rising prices. And that's kind of the basics of what we're seeing. So inflation occurs when aggregate demand exceeds aggregate supply. Right now, demand for goods and services is high because households have a lot of savings. Some of that was saved up from COVID, whether it was through government stimulus or just not able to spend, but a lot of that money is still in household savings. There are some deferred purchases during COVID, right? Not just Taylor Swift concerts, but travel and automobile prices were high. So that demand is still out there going after goods and services. But the supply for goods and services is still restricted. Our supply chain disruptions persist. In the US, a lot of us feel like we're kind of back to normal from the COVID economy, but many of our international trading partners, especially China, are still experiencing significant economic impacts from it that are restricting their ability to produce goods and services. Low unemployment is making hiring challenging. We're hearing a lot about the labor shortages, and energy prices have increased. And this is, largely, or, maybe mainly due to Russia's aggression in Ukraine, and other geopolitical events are driving all these things. So we have a demand exceeding supply, and therefore prices are going up. See that Econ 101, it comes in a little bit handy. And so this is just a representation here of the consumer price index for the last 10 years. And you can see that during the decade of the 2010s, or whatever we call that, consumer price index is the overall prices were relatively stable, going about, between around 2% on average. And since then, and this graph is a little bit different than anything you might see, because I actually do this on a month-over-month basis. Not when inflation gets reported, it's usually based on what happened in the previous year. Well, from a month-to-month basis, what we saw last month, the most recent, the far right bar here, we see that being a little bit lower at about 3.5%. Excuse me, I'm coming off my own case of COVID here, so I'm a little bit dehydrated here. So what we see here at the end is about 3.5% was the most recent reading. The November report will come out a week from today, and it is very critical. Like most of us, like even as an economist, we're not always in tune to watching every number that comes out. But the November number is going to be incredibly important. The last month's number came out. It was lower than expected. This far right bar was one of the lower readings we've seen in a while. And it suggested that maybe inflation is starting to come down to a more normal level. The problem is you see some lower bars throughout this, and then it pops back up the next month. So where this number comes in next Tuesday will probably be a very volatile day in the market. If it comes in low, then I would expect the stock market will go significantly higher. But if it comes in high, then things will go the other direction. So we see that prices are in fact rising at an unacceptable level. Oh. Okay, so what's being done about that? Well, the Federal Reserve really only has one tool when it comes to managing inflation, and that is the interest rate. And it's basically on the demand side. When the Federal Reserve raises its rates, then it's basically, it can't really improve supply. It can only decrease demand. And it raises rates to do that. And you can see that the Federal Reserve funds rate went from close to zero by the beginning of this year to approaching 4%. And it's expected to go even higher before the Fed pulls back on that. How much higher will continue to be dictated by the inflation numbers that continue to come out. Well, the federal funds reserve rate doesn't really matter to like most of us Americans, but what does matter are things like mortgage rates. And you can see the 30-year mortgage has gone from just over 3% at the beginning of this year to hitting over 7%, having backed down a little bit in the last couple of weeks. But this has a real cost in terms of consumers, people wanting to buy houses. The average mortgage rate I was looking at for just kind of a typical $200,000, $250,000 house, the payment based on just the mortgage rate alone has increased by about $500 a month. So this is going to put a damper on consumer spending, and we're going to see that going forward. So that's kind of what the Federal Reserve is doing. They're raising rates. And so, but the question is, what about the jobs market? Well, the unemployment rate is quite low at 3.7%. It seems like it's the job market is booming for people who want jobs. We've continued to add jobs throughout the recovery, and this doesn't seem to have any real signs of slowing down. So that's a good thing, but that doesn't help with the inflation situation necessarily. And if we look at the all employees number, we do see that even though in unemployment is quite low, we just this year have recovered to the number of total employees that we had pre-pandemic. So it has taken us until August of 2022 to get back to January of 2020 numbers. So even though we're having job growth, there's still probably room for more workers to be out there. If we look at the healthcare industry specifically, it's very similar. In fact, it was September of this year when we surpassed the number of healthcare workers from January of 2020. But if you were to project this line out before the pandemic, you'd see that we'd probably be at a significantly higher number. And these numbers on the left here, so it shows about 16.6 million healthcare workers in the US, probably based on our demand, where that was heading and our aging population, that would probably be well over 17.5 million workers that we really need. So there's a significant shortage in the healthcare industry. So given that unemployment is so low, where are the workers? And the answer is they're not in the labor market. So what economists focus on is called the labor force participation rate. And this number pre-pandemic hovered between 62.5, 63%, rising a little bit right before the pandemic. And not surprisingly, it dropped significantly, but it is yet to really recover. So we are missing workers. Some of that we know is due to an aging population and just more retirees, but even among working age, we don't know why there are not as many workers as there used to be, and if and when this will recover. Again, there's a lot of theories. Maybe it's because of the pandemic directly, people taking care of others outside of the workforce, people staying home with kids, like whatever those stories are. To be honest, when I look at this chart, most economists have projected that with the low unemployment and with rising wages, that you would expect more people to have come back into the job market, and that would definitely be a good thing. And we're not seeing that happen. What's going on with that, not surprisingly, I guess, is with inflation and a shortage of workers, we are seeing rising wages. So this is the average hourly earnings of all employees. And that last number, and this is on an annualized growth rate, that last number is about 6.8%. So wages are rising about 6 to 7% right now, which is on the one hand, probably a good thing, because if the inflation is rising, the cost of goods is rising, people's earnings should be going up as well. So that's fair. The concern with that is that as wages continue to rise, then businesses will have to continue to raising their prices in order to pay their workers more. This is known as the so-called wage price spiral, and especially in service industries, and healthcare specifically, and other education, a lot of service industries where those wages make up a huge percentage of the business's costs. Those wage increases need to be passed along, and that creates an inflationary cycle. So that's kind of what's going on with inflation right now. I, projecting out where it's going to be, I think we're seeing stabilizing. I think we've hit peak inflation, if you will. I mean, the month-to-month numbers can be very volatile, but I think we're going to see it coming down from 6 or 7% what it was earlier. Now we're bringing it down to, we're going to start seeing readings in the 5%, 4%, but the Fed is not going to stop acting until they're comfortable that it's going to get below 3%. So with inflation, then the question is about the recession and economic growth. And the questions I'm getting is, what is a recession, and are we in one right now? Why does everyone think one is coming if we're not in one, and how can we prepare for that? So just the economic definition, and it really is kind of a strange thing. There's an organization of economists that gets to determine if and when a recession occurs, and their definition is that a recession is a significant decline in economic activity that's spread across the economy and lasts more than a few months. So people have taken that to be, well, if you have 2 consecutive quarters of negative GDP growth, then that's probably a recession because it's more than a few months. But we actually had that earlier this year, but it really wasn't considered a recession, in part because by some other measures, the economy was still growing, even though there was that slight negative GDP read in there. So my simplest answer to, are we in a recession, is that it probably doesn't really matter. So a recession is kind of this weird, like, binary measure of something that is continuous. So, are we growing or are we not? What we know is that we're going to have an economic slowdown. And an economic slowdown will follow because of those rising interest rates. It will basically deter investment among, individuals going out buying new houses, but those same interest rate increases also dampen investment from individuals or from businesses that may not be making other sort of business investments, and that should cause a slowdown in economic growth. So we're not in a recession yet, as far as we can tell, but also you don't know until we kind of go back and see. It's I guess it is possible we're in a recession now, because if fourth quarter GDP comes in very weak or negative, and that happens again next year, then we might end up with a backdated recession to this state. So all that to say is that, whether we're in a recession or not, or whether we're heading for one, kind of is not really the most important point. What it is more thinking about, how do we deal with an economic slowdown that is likely to come, either, whether or not we actually get to a full-on recession. So want to talk a little bit about some financial markets. This has been a really lousy year for the stock market. You can see that we had great growth in the stock market after the pandemic. The markets dropped pretty aggressively heading into the pandemic, but when we realized that things were getting better, then we had almost 2 years of strong stock market growth, only to have things come down significantly this year. And that's really partly also due to those rising interest rates. Rising interest rates are bad for stock valuations. They're also bad for most investments. That includes bonds and other sort of like fixed income or other assets. Rising interest rates are pretty negative for any of the investments. So if you have your 401k statement from the third quarter and it's sitting there and you haven't opened it, like just throw it away, like get rid of it. You don't need it. Because there's nothing in there that's probably going to help you make a better decision. The market is forward looking. And while we've seen decent economic growth this year with some, good job growth, low unemployment, the market is looking towards next year and it is anticipating a recession. And that recession is already being priced into stocks in a way that they're expecting earnings to be weaker this year. Corporate earnings have actually been a little bit stronger this year than a lot of the analysts have expected, yet we've still seen declines in the market. If you're thinking about, okay, well, we're heading into a recession, maybe I should sell my stocks or do something different, the answer is you're probably too late. Again, that's already priced into the market, and really trying to be able to anticipate when the markets will decline or bounce back is extremely difficult. Just to give a little perspective, I went back and looked at how the stock market performed in the last high inflationary period. And in the late 1970s to the early 1980s, we had a 5-year window of high inflation. We had, to stem it off, the Federal Reserve raised the rates to 20% at one point. The federal funds reserve rate went to 20%. Mortgages were higher than that. During that 5-year stretch, we had 2 recessions. But during that stretch, the market was up 4 out of 5 years. And the one year it was down like 9%, but the other years it was up double-digit percentages. So even though the general economy was in lousy shape, the stock market performed reasonably well during that time period. Certainly a lot better than if you'd pulled out and held out of it. So just don't get overly reactive based on what the stock market has done or where you think the economy is heading, unless you're just sure that we're heading for an economic Armageddon and you'd feel more comfortable with your cash under a mattress. Then I guess you need to do what you need to do. So with that, I just want to talk a little bit about kind of what we see going forward next year. So growth will remain slow to flat for the next few quarters. I say in here there's likely to be a recession, and I believe that's true, that it's more likely than not. You can hear anything on kind of the radio right now, or I listen to a lot of Bloomberg, and they bring in a lot of different economists, and some of them are 100% sure that there's going to be a recession. Others think there might be a quote unquote soft landing, a way that we can pull back demand just a little bit to ease inflation. Recession. But I think it's more likely than not that there will be one, but I think it could be relatively mild. I'm not expecting a 2008, 2009 sort of crash or a 2001 sort of severe recession. And I do think we'll avoid a 1979 type scenario. And again, if you're too young for that reference, in 1979, the way the Federal Reserve or 1980, the Federal Reserve was able to get inflation under control with a huge increase in interest rates that really depressed the economy, but it finally brought inflation under control. I think we're already seeing some signs that inflation is tempering down. And a lot of these biggest factors are still kind of outside of the realm of economics. There's certainly geopolitical issues that could play into this. Russia is not a huge economic player, but the impact of that ongoing war and any escalation is certainly having a bigger direct impact on Europe. But, Europe, a lot of countries in Europe are big trading partners with us. So I think we're going to continue to see that we are at risk of geopolitical turmoil having real economic consequences here. The COVID recovery, again, especially in China, I think is a very important story that will kind of determine whether we can increase our supply, our ability to produce goods and services in the country at, without raising prices. That's still a big story there. Consumer spending, it doesn't show any signs of slowing down right now, which is kind of a mixed blessing. Because as we have strong consumer spending, we're not heading into recession, but we're also, that consumer spending being so strong is one of the things that's adding to those inflationary pressures. The fact that consumers haven't quit spending as prices have gone up means that companies have continued to raise prices. And that's why that inflation has been so persistent. And right now, we're whether we like it or not, we're putting a lot of faith in the Federal Reserve to basically raise interest rates, kind of that knife edge right amount that will dampen demand a little bit without just sending us into an economic tailspin. And that's a difficult thing to do, because the decisions that the Federal Reserve makes now with regard to interest rates really takes 4 to 6 months to kind of feed through the economy. So if they overshoot it, then we won't know for 4 to 6 months, or if they undershoot, we'll continue to see. So it's I think sometimes the Federal Reserve has to drive the car while looking in the rearview mirror and, trying to anticipate when to make turns, and it can be quite difficult. And, they came out, and the chair of the Federal Reserve this week basically came out and acknowledged that maybe they were slow to react a year ago when the signs of inflation were coming on. But now they're saying they're going to be as aggressive as they need to be. So with that, I'd love to hear what questions are on your all's mind. I know there's a lot here.
Well, that was a lot, Kyle. I've been playing around with the stock market. Now you have me rethinking what I've been doing. I don't know. Sometimes it's easier to do nothing, right, than do something that you think might possibly happen.
Yeah, I'm a big proponent of, a rainy day portfolio, like that you ought to find a balance that you think is going to work, rain or shine. And then, don't check it too often.
Right. So if I were a manager of a unit in healthcare, what would be the biggest things I would want to be thinking about as relates to my own budgeting process for my group next year? Like, how is this going to, do you think, roll through healthcare organizations such that it might impact specific departments?
Yeah, it's a great question. I think so many healthcare organizations are different based on whether they're for profit, not for profit. Obviously the same sorts of pricing issues don't always work the same way in healthcare. I know that a lot of the folks I talk to in healthcare always talk about, one of the things we said is, businesses should raise their prices because wages are going up. And then, physician groups or hospitals come to me and say, yeah, like, I wish we could just raise our prices, but it doesn't really work that way. So I think budgets are going to continue to get squeezed in healthcare, but that's really probably nothing new. We're seeing challenging reimbursement environments in a lot of different areas. One potentially piece of good news that could come through is I I do think that some of this labor market shortage may work itself out a little bit. And so that we may see more opportunities to hire workers and, hopefully get up to fully staffed in 2023 in a way that a lot of organizations probably haven't been since 2020.
Yeah, but it sounds like we can't use dollars to attract them. So I don't know if I'm definitely putting you on the spot. If you've heard of any best practices or cool things people are doing that people are responding to, or are you suggesting instead they'd have to take a different professor's class to learn about that?
That's right. I, I, I think that, right. That to me, it's just all like a chart and a graph, right? Like, where does it intersect? But then, yes, you need leadership to understand how to actually get that job done and motivate those folks.
Yeah, it's challenging today. And I think it's going to be challenging in the future. I do hope the labor market sort of sorts itself out, but we'll have to see. All right, folks, who's got a question for Kyle? I'm trying to remind myself what the last recession was like. We can remind ourselves what we learned from before. So Kyle, there is a question in the chat. Although we see job growth, we see people not returning. Is there a qualified for the quality of jobs being added, full-time, part-time benefits, pay scale? What are you thinking there?
Yeah, so I mean, a lot of times what a lot of the government numbers, you're precisely right. Treat a job as a job, right? Like how many jobs are being added, whether they're quality or not. But what we know from the kind of the job openings number is it really is across the board. There, we are seeing a lot of obviously entry level, service industry, especially. We know that restaurants have been shorthanded for a long time. So jobs at the lower end of the pay scale are definitely in high demand, but we're also seeing it in at the higher end of management levels that organizations are struggling to hire. So jobs are being added, I think, throughout the kind of spectrum in terms of quality. One thing that I think, may contribute a little bit that we've tried to delve a little deeper into is that there are some folks who I think before were working two jobs in a kind of in a bad labor market, and now we're only working one. And that's probably a good thing, but it does tend to lead to a labor shortage. So some of this just may be the fact that instead of working, moonlighting a night job as well, then people are getting a better job and holding on to it.
Yeah, and Tora raises an interesting question. I don't know if you feel comfortable addressing this issue, which is that, as jobs go more remote, then we're not just dealing with the local labor market, we're dealing with the national labor market. Any thoughts you've seen about that trend and how it's going to change?
Yeah, I mean, I don't know. It's interesting to me. So we've, as part of this business outlook panel, we go out to cities around Indiana, and we were out in Richmond, and some folks were complaining about this out there where I think it was in the banking industry. Banks in Indianapolis were actually going out to Richmond to try to find skilled workers to work for them remotely, so they could stay in Richmond but be working in Indianapolis. And basically Richmond was like, hey, we've got enough brain drain here, and then like these organizations are coming and raiding our talent and having them work. And so I do think it's a process, but it can potentially cut both ways, right? Like if you're competing with other states, you also maybe have a broader labor pool where if you have remote workers, you can pull people in as well. So, and wage gains have not kept up with inflation fully. And yes, at IU, that is a slow process, and a lot of kind of institutions aren't going to respond, and they're not going to look at my inflation numbers and say, okay, Kyle, like, well, let's bump up your salary this month. Like it does not work that way. So, you know, a lot of workers are feeling that way. And that's why I think the Federal Reserve is prioritizing really bringing inflation under control.
Yeah, absolutely. And let me ask you one last question. So let's say that I desperately fell in love with a house and I really have to sell my house today. What's the best advice you can give me in this market?
Um, well, I mean, I guess it's like, can you put a price on your love? Because it's likely that you're going to have to list your house at, you know, for a lower price than, you know, you would have done a year ago. And, you know, I,
Right.
I think that it's hard to predict where the interest rates are going to like end up and where mortgage rates will end. Although, again, we've seen a little bit of decline. I think that it's very possible that mortgage rates have peaked right now, and that if in fact we're bringing inflation under control, those longer term interest rates, a 30-year mortgage, may top out around, you know, 6% or so, and should decline if we're successful, you know, going forward. So there may still be an opportunity.
I think we just have to get creative in helping people see how to afford it. So I have two last questions. Let's take the first one, Kyle, out of the chat about an independent pharmacy where the reimbursements are practically below cost. So how do you pay a competitive wage um, with these sort of regulated situations? Any thoughts or suggestions for that corner of the healthcare industry? It's
No,
a
I
tough
mean,
one.
like it's extremely difficult. I mean, I know, and I used to be involved with specialty pharmacy, and it was exactly that. You were told what your reimbursement was, um, and I it's really, I mean, it's an extremely challenging, and basically the payers have all of the control, and all you can do is focus on the cost side, and then, you know, lobby to whatever extent that you can for higher reimbursement levels. But I'm sure you're already doing that. Um, it, it's it's a struggle, and I think it's why what we're seeing on the provider side is so much consolidation. Pharmacies
Yeah.
realize that they can't exist on their own. They need to have market power. And really this story is played out throughout healthcare. And so what you see is on the provider side, more consolidation, bigger groups, bigger hospital systems, all trying to get more market power. On the payer side, you see the same thing, and everyone's struggling. And a lot of the smaller, the independent providers are getting left out in the cold.
Yeah, absolutely. Um, Yeah, so I don't know if you saw the response, which is they are doing those things. Thanks for reaffirming that they're on the right path, right? I mean,
Yeah,
some
I wish I had better. I wish I had some like magic bullet pull out and say, oh no, just do this.
no, but I mean, you have to make the argument from a we can go out of business standpoint. I think when you're having to pay more than you're making, it's a challenge. All right, and so okay, all right, so we have some folks talking to each other, so that's a good thing. The labor is a challenge, and I just want to encourage everybody, if you want to understand what tools and frameworks can help you analyze your business operations and think about where to make improvements. I mean, one thing is to figure out how to do more with fewer people without killing the people you have. That's an approach that uses process improvement. And our graduate certificate is a year-long program where we walk you through all of the basic business acumen, so you can think about all the tools that can be leveraged in order to bring your organization into a more successful position, from how to lead people to how to analyze your operations and think about where margins are, to how to recruit more customers or patients, and even how to manage your processes. So if you're interested in that, please reach out to myself or Janelle Sissel on this webinar, and we can help you with that. Thanks for joining us today. I think we're going to give you 3 minutes of your lunch hour back. and hope that the rest of your week is more upbeat than perhaps our economic forecast is. So thanks for joining us today. Any last words, Kyle?
No, thanks for having me. I was typing a reply to Pauline on her question that we didn't get to. So, but yes, I don't think I think it's uplifting. We're going to be all right. Like we're going to get through this, right? Like the worst is past. I know it, but so it's a challenging environment, especially in healthcare, but brighter days are ahead.
Awesome. Thank you again, and hope to see you all in class. Bye.